I'm Alexandra Scaggs. I'm with Barron's, and I am here interviewing Dan Rosen. So can you tell me, I guess, a little bit about your fund, sort of your strategy, what you guys do?
Sure. Yeah. Hey, it's great to be here. Dan Rosen, general partner at Commerce Ventures. We're a VC firm, obviously focused on early stage investments in the fintech ecosystem. We also invest in infrastructure for retail. So retail and financial services are the industries we think a lot about. Early stage for us includes actually seed, Series A, Series B. And the things that make us a bit different from most firms are one, pretty strong sector focus. So we'll actually be thematic from the start of a thematic deep dive that hopefully yields investment opportunities that we pursue. And it also, the thematic focus and sector focus also means kind of we care a lot about the corporate ecosystem around financial services and retail. And I could spend more time talking about how we put that into action. So that's sector focused. And the other difference between us and most firms is we almost never lead the rounds that we invest in. And so when you think about those two things in combination, assume for a second that you're doing a thematic analysis and you come to an opinion on which company you think is best positioned to win a category in that theme that's interesting. How do you maximize the chances that you can invest in that business? And our belief is that actually we could maximize our chances of investing in great companies by being willing to invest small amounts alongside kind of a more traditional lead investor. So those are the two key differences between us and most of the folks who will be on stage here.
And so I'm actually a markets reporter. I cover fixed income markets, interest rates, stuff like that. And I thought this would be a good opportunity to talk to you about sort of where we're at in the economic cycle and what it means for your strategy. So I'm sure you're aware that the yield curve is inverted. People seem to think that means recession is on its way, either in a year and a half. So how is that changing the way that you're looking at companies and investing?
Yeah, so gosh, I guess when you think about yields, that really plays into valuation more than anything else in our world. And of course, those two things have a lot to do with kind of access to capital, which also matters a lot to companies that are burning capital. We like to invest mostly in enabling technologies. We think about them as kind of platforms and enablers. So most of those businesses have kind of high gross margin kind of business models where kind of they shouldn't burn hundreds of millions of dollars before they can get to the point to be kind of break even. So one is that sort of capital efficiency matters to us, and it matters to us even more when you're worried about the availability of capital a year, 2 years, 3 years down the road, and pricing at which that capital will be available. On the way in, though, these days we spend a lot of time scrutinizing valuation, and I would say kind of equally there's a lot of aggressiveness in terms of valuation in the market for what might be the most attractive or the most hotly pursued deals. Certainly, we see that at the kind of the Series A and Series B for sure. And then, of course, as companies get more mature and they're kind of they can be even more highly valued. So we tend to avoid the companies that have the, I guess, most aggressive valuation multiples at the entry point, because I think our belief set is that those multiples won't be sustainable. So the company has to grow that much further in order to just make up for the compression in the multiple at exit.
Okay, so I have two questions now. That was a really interesting point. The first one is, when you say enabling technologies and enabling platforms, what does that mean?
So, at the core, we start with enabling technology, and the distinction I would make between, kind of an enabler and a platform, they're not mutually exclusive, but, we invest in enabling technologies that, we would love for someday, for them to someday be platforms. The distinction there is really, enabling technology is something that, kind of helps another player, it's probably a financial institution or a challenger, deliver some, kind of capability or service or user interface that they view to be strategic for their long-term, kind of their long-term mission or goals. I can give you examples of those, but a lot of them are in the digital banking and digital financial services ecosystem, and they're technologies that enable kind of the opening of accounts, the delivery of capabilities, the sort of processing of transactions. Now, if we're lucky, those companies kind of have a first direct hit with their initial product, and then those products kind of enable them to get to a meaningful scale at which they can cross-sell other capabilities. At that point, they sort of become a platform, or that's one way they could become a platform. So we usually underwrite an investment without assuming that platform success, but we love it when that's kind of the outcome.
That makes sense. And then when you were talking about valuations getting high in some areas, I mean, do you have sectors where you're seeing that a lot, or any particular areas you guys are shying away from?
Yeah, so I don't think we're shying away from sectors because of high valuations. We do see high valuations in a couple of key areas in fintech. I'm sure you all are aware of them. Certainly in consumer fintech, I almost think there's the clear, sort of, high-flying companies that have a lot of momentum, and those guys have, very attractive valuations, attractive for them. And so I think in the consumer space, you see that a lot. We don't do as much in the consumer space, as I mentioned, because we're mostly focused on infrastructure and enablers. But that is a category where we certainly see higher valuations for companies getting to scale. The other area is payments. And I'd say almost across the board for companies that have meaningful traction in the payments world, there's a lot of capital chasing them. And as we know from basic microeconomics, when supply exceeds demand, price goes up. So price goes down. Yeah, I'm getting it flipped. But the price effectively goes up because there's way more capital chasing very few deals.
That makes sense. And so within the payment space, I mean, how much more is there? Because basically, I'm aware of PayPal and Venmo and this sort of consumer-focused payments companies. But are there platforms that you find particularly innovative working with banks or like other steps in the process?
Sure. Yeah, I mean, there's a lot of interesting platforms out there. I'm totally biased, by my own portfolio companies. But I think, if I have to exclude my companies, I would say, there are firms who are doing a great job in terms of, platforms for next generation financial services. I think, we've all seen, kind of what Plaid has done recently. I think their acquisition of Quovo was brilliant. And we are investors in Marqeta, which I think is doing an exceptional job. They tend to serve more challengers and next generation commerce players than incumbents to date. I think that will change over time. A lot of our portfolio serves large and medium-sized FIs, so we love those companies, but they're the sort of the unsung hero of digital financial services. So for example, like a company like Socure, who's helping to digitally identify or verify the digital identity, I should say, of folks who are applying for new accounts. They make that process much smoother, but you should never know they exist. I mean, so fundamentally, a lot of our companies look like that.
Right. And at the point we're at in the market now, I mean, we've seen some high-profile IPOs this year. Hearing a little bit more about exits for some of the later-stage startups. What sort of environment is it now for IPOs, and are you guys looking at exits? How does that?
So I think this year is the first year, and I think it's coincidental. It's the first year that we have companies that are, I think, at a scale where they're starting to really think about the IPO path as being realistic for them. But I think if any one of our portfolio CEOs were here, they would tell you, especially the ones that are at scale, you can't sort of manufacture an exit. You can certainly chart a course, you can plan and prepare, and then there's a point at which you might be a candidate to go public, and you might sort of make the decision at that point whether or not you think the markets, kind of warrant, or create a good opportunity for you to take a company public. Certainly on the M&A side, kind of you're building. Most of our companies are just trying to build their businesses, and there's an old saying that companies are bought, not sold. So I don't think many of our companies often are trying to orchestrate an M&A event unless they're feeling like they can't be independent. And once they decide that, maybe it makes sense to pursue an exit. In terms of the environment, we've definitely seen kind of a number of IPOs. I think it's so difficult to know whether or not it's a good environment or a bad environment because of lots of sort of macro kind of activities and fluctuations that are affecting some of the IPO performance and just the market performance in general. It's an area you probably know a lot more about than I do, but the ride-sharing companies sort of color in a weird way, kind of some of the other successes in other IPOs from the tech world that I think would generally be characterized as very positive. So I think we're optimistic about IPOs.
And do you have a couple of examples of IPOs that have done better and sort of, are there different corners of the market that seem to be doing better that way?
Yeah, I mean, I would probably just backtrack a little bit to the, kind of, look, the dirty little secret of fintech that we probably all realize, maybe we don't talk about, is that there actually haven't been that many fintech IPOs in history, like just ever. So if you think about non-charter financial institutions that raise venture dollars and then go public, there's just not many. I mean, Green Dot, Netspend, there are a few others depending on how you calculate or how you define, kind of the space. More recently, Adyen and Square, I think, have been, fantastic successes. So I think that's why you see so much excitement about payments, because people are like, okay, that's an area where you can build value, you can build a business, capture value, and you get rewarded for that business model in the public markets. And also just the secular trends around, kind of the payment acceptance and moving money globally are super friendly. So.
And to change tack a little bit, when it comes to fundraising for you guys, I mean, what's the environment like for that now? Because, you look at yields, and yields are very low in treasuries and other safe assets. So, I guess maybe you can talk a little bit more about that.
Yeah, I mean, 6 months ago, we were worried they were going, that rates were going up. So it sort of depends on, when you had this question and what you believe. So I'd say it does feel like it still feels like we're towards the end of a cycle. It does feel like, despite the sort of looming, question about rates going up or down, it doesn't feel like there's unlimited capital out there for, kind of more commitments to venture funds. I think if you're on Fund 3 like we are, hopefully you have enough, kind of track record and data on the investments that you've made in order to be attractive, or at least to demonstrate your strategy in a way that could be attractive to investors. I would bet it's probably a little bit harder right now to start Fund 1 than it was, 2, 3, 5 years ago. We started 6 years ago, so again, sort of fortunate, and just in terms of timing. But I would imagine that there will be a slowing of new capital formation around completely new firms, and part of that is, related to yield. But I think a lot of it is just around, kind of the amount of money that has gone into new firms and the desire amongst institutional investors to actually concentrate their portfolios on those firms which they made bets on, which are now showing real results.
And as we sort of move, I guess, more into the sort of fintech consolidation and maturing of that industry, it's been really interesting to see some firms sort of consolidating and growing. I mean, do you think that some of these firms have a chance to compete with traditional banks? Do you think that that's going to be more of an issue?
I think that they believe that they do.
Okay.
And so I think the question about whether or not they'll be effective at competing with banks probably hinges on whether or not they're willing to become banks themselves. Mm-hmm. There's an efficiency and profitability around utilizing both sides of your balance sheet that I think is just hard to ignore at scale. And so my guess is at a certain point it'll be too tempting to not pursue a charter for some of these neobanks, especially the ones at meaningful scale. The other side of that argument is that banks are valued differently for the most part than tech companies and even kind of private neobanks. So that's the trade-off, I think.
And part of that's regulation, right? I mean, how much of the growth in this area do you think has been because it's sort of been in these unregulated corners? And of course, then if they grow even further, you all of a sudden put yourself under the purview of the Fed and other bank regulators.
Yeah, I mean, I don't view them as unregulated. I think they are regulated. I mean, every one of our companies and the companies they serve that are challengers, complies with regulation all the time. But I think you're right that they're not regulated at nearly the levels that a bank is, and it definitely they have a lot more operating flexibility and flexibility to be nimble in ways that banks often can't. So does that benefit the private, unregulated, as you said, startup in fintech? Yes. But I think the sort of long-term survival of banks themselves probably requires them to be more nimble themselves. And so actually solving that problem in a compliance-friendly way is actually at the sort of crux of the issue that most large FIs have to figure out, right? I mean, we just saw Fin being shut down. So the way in which big banks innovate is, I think, at the heart of the question of our industry right now.
And so I know that you were saying that the sort of enabling technologies are what you guys look at. I mean, does that mean sort of, companies that are working with banks that could get bought by banks? I mean, what are you guys?
You never say never. Most of our enabling tech companies probably won't be bought by banks because the value maximizing event would actually be for a third party who sells technology or processing to banks to buy them, and then it would add to their portfolio. So I would think more likely acquirers would be, kind of payment processors, card networks, bank processors, maybe even credit bureaus. Those are the types of players that, one, make a lot of acquisition. Two, often pay a lot. They pay technology multiples, in many cases for those types of businesses. And there's a long track record of growing, by buying these types of businesses and integrating them in, and then cross-selling them to their whole base of customers. Those are the most likely exits, I think, for most of our companies. But we've definitely seen banks, kind of make acquisitions in the tech world. So I don't think that's impossible.
And a lot of those payments type industries that you're talking about are pretty consolidated at this point. And that sort of raises a question for me about scale. It seems like a lot of the goals in VC investing is to achieve scale, and we've seen sort of regulators and politicians and voters start pushing back against the idea that companies should be really big and have a really broad reach. So are you thinking about that? What does that mean for your investing strategy?
I can't wait for one of our companies to be on, kind of the antitrust regulation, sort of roadmap. I don't see that as a big issue for companies in our space. I think it's, there's only probably one or two companies that I can think of that would be, would be sort of at risk there. Although we're facing, kind of the approval of a couple of, actually three, almost mega mergers in the financial technology and payment space right now. So I think we'll learn a lot about how regulators think about, kind of market structures and competition from, kind of how those, merger processes go through the approval, the approval process. So, but generally speaking, I think people are optimistic that they'll actually be approved, which makes me think those aren't likely going to be, kind of, and as long as there's a few of them, I think we're okay in that space. So I don't worry about it as much for our companies. I hope it becomes a problem. I hope it becomes a problem for them. So.
And so it seems like we have a couple minutes left. So we can do this sort of underrated, overrated game So I have a few suggestions here. Do you think AI is overrated or underrated?
I'll go with underrated there. Mostly because I think most people don't know what they don't know about that. And today we're dealing with mostly narrow, based AI, and I think general AI is the opportunity that most people can't really understand. And I think we're also just in such an early innings of AI, even though it's as a concept been around for decades. But I mean, every one of our companies, almost without exception, is leveraging AI in some way. And again, it's fairly narrow. So I think there's a lot more to be done in the space. So.
What about the valuation question with AI? Do you think it's overvalued? It just seems like companies put it in there and then all of a sudden people are willing to pay more.
Not really, because I don't know, at least in our experience, I mean, we see a little bit of that at the kind of like $0 to like low hundreds of millions of dollars range. But actually, I think when you're building a big independent, first of all, I mean, the big platform companies dominate, sort of horizontal AI as a utility. So, it's really more about, kind of folks who are a little bit more focused in using AI to solve real problems. That usually generates revenues. And so I think that actually solves itself kind of over time.
Okay, so the next term here is blockchain and cryptocurrency. Overrated or underrated?
I'd probably say overrated there, relative to where we are in the evolution of that technology paradigm. Maybe longer term, it'll be underrated.
Why is that? Just the hype around it, the valuation of Bitcoin? What's the?
Yeah, I think things. in the sort of monetary world, things move, I think, a lot slower than many blockchain and crypto, which, by the way, totally different areas that overlap a little bit. But things move a lot slower than people want them to, and then they don't generate as much value consistently, and then investment interest will wane, which it has a lot in a lot of those areas. And so I think that expectations gets reset, and so they slow down. So like, in general, I think the way that kind of technologies gain momentum over time is positive feedback loops. And I think we're seeing too many negative sort of feedback loops there for it to be kind of a near-term hit the way that I think a lot of people want it to be. So.
Great. Well, I think that's all the time that we have for today, but thanks so much. And for our next session, please welcome Julie Verhage of Bloomberg.